All right, so I've been thinking for a year now, what does a watch list look like on steroids? A highly custom watch list. So I built my own tech stack using Claude AI, Netlify, Google Sheets, and Google Scripts. And I'm going to show it to you real quick right here. So this is the main database, and all of it's connected to this backend that I built. And so I keep all of my notes for all of the companies within here. And so you can see it's all filterable by different categories that I have them in. And then you can see within each company, you can flip the categories. As you change anything on this front end, it automatically alters the back end as well. So today I thought we'd break down Nvidia and go into how I use this database to organize my thoughts and keep everything together. All right, let's jump in. What we're going to do is we're going to actually go through looking at how I would use this. So I'll start with Nvidia. Market cap 4.2 trillion. So we added that here. Catalyst. Let's see when's the next. Honestly, earnings are never a catalyst for it, but May 20th is its next earnings. So we'll just put that in there. Bucket theme. I'd say this is probably interesting valuations, but we'll get through that. And then tech semis. Stage. We don't have a stage yet. We don't have a decision yet. All right. So now we start here. Synopsis, value orientation. All right. So usually I'll start with the valuation here. So 35 PE. I prefer to look at trailing 12 months. So 35 PE here. Definitely overvalued on the surface, but you need to then go to the growth to understand how that correlates. And you can also just see based on quick numbers, the PEG ratio is below 1. It's really below 1, which means that we're expecting fast growth. And so it's a fair assumption that this 35 PE today can potentially 12 months from now get to, 25 or so. So going to the growth here, revenue growth off the fucking charts, 65%. Unbelievable. It's unbelievable. Every one of these numbers. We'll look at the return on equity growth. I would assume that's probably because they are spending some of their cash on investing. So they're actually, no, I guess it'd be the opposite. They're probably growing so much equity. Let's look. Yeah. Oh my, it's insane. They grew equity from 20 billion to 40 billion to 80 billion to 160 billion. So they have so much cash they don't even know what to do with. And so therefore their growth metric on their return on equity is going to look negative, which is actually positive because they're just growing their equity like crazy. So yeah, this is insane. All of this is insane. So what I would then go back here is I'd look for the probably look at income statement, and I would write something like actually no, I'd go to valuation metrics and growth. So 60% rev growth. Let's see what it's done year over year. 26, 60, 130. I mean, that's insane. It's growing 50%. Probably growing something like 50% plus year over year for 3 years, which is insane. By the way, how cool is this? So now you go back to the chart, you look at the Nvidia, it's adding this into the valuation metrics growth tab. So I have a 1-to-1 replica backend database that's tracking all this. All right, so that's impressive. Revenue hit 200 billion plus rev for first time. Just really amazing. And then I would say PE is 35 for this. I don't love. Enterprise value to sales is 20. Price to sales is 20-ish. So I would make a note of that. EV sales and is 20. Don't love. as absolute number. All right, so why is the price to sales ratio high, but the price to earnings only quote unquote 35? We'll take an example here of company A versus company B. Company A, let's say they sell one cup of lemonade for $1, only have 10% income margins. So it takes them 10 cups in order to make $1 profit. So if I were to buy that business for $200, I have to ask myself, would I pay $200 to get a business selling 10 cups a year? But in this scenario, there's $1 of profit per 10 cups. That means that I'm paying 20x sales or 200 times earnings. Whereas if a company B, let's call this one Nvidia, has a higher margin, so they still sell each cup for $1, but they have 55% income margins, which is what they actually have. Then it only takes them 2 cups in order to earn $1 profit. And so if I ask myself that same question, would I pay $200 for a business selling 10 cups a year? This scenario is much more palatable because we're only paying a 20x sales or a 40x profit. Still high, but considering Nvidia has one of the highest profit margins in the full tech industry and really in the world right now with this 56% net income margin and gross margins near 70 to 75%, that makes this price of sales look high and yet the price earnings somewhat reasonable. If I had to put a price on it, I'd want to see Nvidia get down to a 30 PE because Apple's currently sitting at that 30 PE. In order for Nvidia to get down there, Apple would probably have to drop to like a 26 or so. You can see here on the Nvidia valuation sheet that their price to sales is 19. And so the simple formula you can use is PE ratio times profit margin. So in this scenario, they have a 35x PE and a 55% profit margin, which leads to a 19.25 price to sales, which you can see is almost the exact number that they have listed on their accounting. I don't love the 20 as an absolute number, but logically, the reason that's 20 is because they one are growing sales so much. So let's say they grow it again next year. Now that's a 14, which is still too high, but that's a 14. But the reason that that is 14, but the PE is not off the charts is because they have really great margins. So the price of sales is not as telltale in this scenario. You can see their margins here, 71% gross profit margin, insane. What's their net income margin? Let's see, 55%. That's insane. This is the best business ever created in the history of mankind. Okay, return on total their return on total capital is 60%. Oh my god. Okay. Let's see, perplexity. How do I get to I just want to see what their ROIC is if it's that different ratios. Okay. Oh my gosh. Their return on total capital, 1,000%. Return on invested capital, 100. That doesn't make sense. First off, why is return on total capital 1,000%, but here it's 63? So now we go to Grok. Either one of these are so good it doesn't even matter, but let's be sure. Net profit margins 55% both, 70% both. So something's weird on this return on total capital. Maybe they're calculating it differently. And we wait, and we wait, and we wait, and we wait, and we wait. Okay. I gotta imagine Perplexity is wrong. 1,000% return on capital doesn't make any sense. 63% return on capital is an accurate figure. All right, whatever. Point being, they have an insane return on capital. So I'm gonna write that. Margins. And then let's look at their balance sheet. I always try to look at just the last year for the balance sheet specifically. Okay, so 10 billion cash. Oh my gosh, this company's insane. They have low inventory and incredible short-term assets. A relatively low gross plant and equipment, which is impressive for how much they have to manufacture. All right, so their total assets, oh my gosh, it's crazy. 206 billion. Okay. Then long-term debt 7 billion, not horrible. Accounts payable, they owe a little money, not that much. So they're oh my gosh. It's just crazy. They have 160 billion of equity. Oh my gosh. This company is insane. I'd also argue they have an incredible moat. All right, so all that's insane. I'm assuming their cash flow is insane. Operating cash flow, 100 billion of operating cash flow. Unbelievable. And they spend 6 of it on capex, so their free cash flow is like 95 billion. All right, then what are they doing with their financing? They're investing in securities. They did a small acquisition. They're really responsible. No, Jensen's amazing. They've issued no debt in 3 years. They're repurchasing $50 billion of their own stock. Oh my gosh. It's just, this is a masterpiece of a business. All right, let's just go look at earnings per share. It's crazy. The earning per share has gone up. Oh my gosh, it's just crazy. Normalized is crazy. Their normalized earnings per share went from 14 cents to 340. Oh my gosh. This company's just insane. I mean, Jensen is the Steve Jobs of our generation. Besides Elon, they're tied. Comps, there's like no comps, but whatever, AMD. All right, so then here's what else I'll do. So I'll take the conversation I had. Usually it's longer, but Nvidia is an easy one, and I'll post a link in here. And then this is pretty unique. So I built a formula in the sheet. So it takes all the notes and then puts into this prompt. Then I post that into Gemini. So then my Steelman link goes in here. And what this does is it's going to poke holes in the thesis. So it's telling me to hold watch. Your numbers are directionally right, but lack the second derivative caution. Stock is currently priced as for a beat and raise perfection, the whole in your thesis law of large numbers to maintain 60% growth rate on 250 billion base. Nvidia has to find an additional 130 billion in revenue this year, roughly the size of two Intels. I mean, it sounds ludicrous, but they're at a 215 billion base. We have Apple at what 600 billion. We have Amazon at 700 billion. Walmart 650 billion. So like, could it grow 50% from here and hit 300 billion? Yeah, no question. It's the best company in history. So I don't know if the law of large numbers applies, but I understand it's a risk. I do agree they probably hit peak margin, but if you're growing 50% revenue year over year for the next 2, 3 years, I'll take some margin hit. China's that's been written off for a while in my head. Surging inventory. Let's see if the inventory's grown. Yeah, they're growing it, but like on a relative basis, what's $21 billion of inventory that they're going to be able to at least liquidate at the worst case for half price, you know? So I'm not too worried about that. And what else? Gemini push back on risk of peak market must beat 70 billion there to move the needle. Yeah, but the thing is, even when they hit great earnings, they don't really move the needle. Nvidia is just it's such a big behemoth. Just one day people are gonna wake up and realize this was the fucking steal of the best company in the world. So all right, so now what I'll do as the next kind of final step is I need to figure out a way to value it. So let's do it on income statement. All right, so as high tech as all this is, I literally just copy and paste this right here. All right, oops, wait, what? Why didn't it copy and paste? It works otherwise. What? Oh, here, let's try this. Interesting. Okay. Well, let's try it this way. All right. And then these are always misaligned. All right. So I'll put all this into a sheet and then I'll just play around with it. So here's my. Oh, interesting. It doesn't have. Oh, okay. I see. There we go. Okay, so now delete this and add this formula I like to use, which is here. Okay. All right, so over the last 5 years, it's expanded revenue averaging year over year 50%. And in the last the last 10 years, 50%. In the last 5 years, 73%. This company is growing like fucking crazy. Now freeze this. And then let's see what its average gross profits are growth wise. Oh my gosh, insane. All right, and then let's take the average. All right, so over the last 10 years, it's averaged 50 billion a year, 36 billion of gross profit, and how much net income? Oh my gosh, it's growing its net income almost 100% plus a year for 10 years. That's insane. it's averaging 27. So at its current 4250, I think that's a trillion, right? So the PE is 153 if you take the average, but it's growing so fast you can't really look at it like that. I just think this company is growing so fast people can't even recognize how fast it's growing. Still, even after all these law of large numbers. All right, so net income is here. It's crazy. Its operating income and its net income are growing 100% on average year over year. It's just crazy. It's crazy. It's so good. Um, These numbers are off the fucking charts. Normalized diluted earnings is probably the most true representation. It's just crazy. It's crazy. All right, so let's just do a fun experiment here. Let's say Jan 2027. So the average expansion for 5 years would be 50%. So if it just does what it's average for 10 years, it'll hit 330 billion of revenue next year. And then let's use the same margins it had before. So its margins here were 71%. So then this times 71, we'll be looking at 234 billion of operating income. What are these numbers here? $55 billion of net income margin is just insane. All right, so I'd say probably middle case, it makes $183 billion of profit next year, which at its current 4.25 market cap would be an implied PE of 23, which is still a lot, but it's good. Let's do that exercise once more. So then if this were to grow again its average, looking at 500 billion so that's 500 billion in revenue in 2028. And then what's this formula? Oops, let's type it up. Okay, so this times this goes this times this equals this. Okay, so if Nvidia just keeps up its average growth rate of the last 10 years, which is 50% of revenue, and maintains some sort of lower end margins. In January 2028, if it doesn't change price, it'll be at a 15 PE. Next year, it'll be at a 23 PE. And this year, it was at, what'd we say, 35, something like that. So I guess it all depends what's your duration of returns. Now I'd have to, let me put these into notes real quick. Okay. So now we go back to this. If Nvidia keeps this. So wait, watch. So it should have added those notes into Nvidia. Yep, here it is. Those are the notes we just wrote in there. And then so then the target price is the last thing we need to think through here. First off, I'll categorize it. Stage, I'd say it's a buy, but must still validate. Yeah. It's definitely interesting valuations, decision notes.
And that little slowdown brings us perfectly to our next section. It's time to put on our skeptic's hat and really start poking some serious holes in this bullish story. We're going to look at the 3 biggest risks that could actually challenge Nvidia's dominance. So what are these storm clouds on the horizon? We're going to break them down into 3 big challenges. First, the inevitable pull of gravity on its crazy high profit margins. Second, a potential rebellion from its biggest customers. And third, a kind of valuation trap set by the market itself.
Let's start with those margins, 75%. That's like climbing Mount Everest without an oxygen tank. It is a spectacular, breathtaking achievement, but it's not a place you can live for very long. When you're operating at that altitude, you are painting a giant, glowing target on your back for any competitor who thinks they can do it cheaper.
And that leads us straight into risk number 2, which is almost like a Game of Thrones plot twist. In a really fascinating turn of events, Nvidia's biggest customers, we're talking the giants, the hyperscalers like Google, Amazon, and Meta, who buy their chips by the truckload, are also becoming their biggest potential enemies.
And listen, this isn't just some theory. It is happening right now. Google's got its TPU. Amazon has Trainium. Microsoft has Maya. So why are they all spending billions and billions of dollars to build their own chips? Well, the motive is simple. They want to keep that sweet 75% profit margin for themselves.
All right, this last risk is a little more subtle. Think of Nvidia's stock like a boat on the ocean. Even if the boat itself is absolutely perfect, a massive storm can still sink it. So if the entire stock market takes a nosedive, Nvidia's really high valuation is probably going to get dragged down with it, no matter how great the company is actually doing.